We've discussed this so many times that until you get the big banks to stabilize in some respects, the market is going to be on shaky footing. Over the last month, all of the big banks, Citi, JPM, Citi and JPM down 6% and 7% respectively. I go down the list and the losses are even greater than that. B of A, Goldman, and Wells, 12, 13, and 14% respectively there. Jonathan Krinsky, again, Malcolm, opining on this, says there's little evidence that the downtrend is over. So what do I do with that?
I don't disagree with that, but I do think we're in an environment now where net interest margin matters less for the big three, Goldman, JP Morgan, and Morgan Stanley. I think that we're in an environment that is ripe for IPO activity. We've got 3 blockbuster IPOs set to happen at some point this year, presumably, between SpaceX, Anthropic, and OpenAI. I think all of those will be additive to the overall system, and I think regardless of how interest rates move throughout this year, those 3 are going to participate in just about every single big M&A transaction that we see this year. So there's still opportunity for them to finish the year strong, even if the entire sector doesn't actually go in that direction.
So you bought Goldman.
I did.
Is that a new buy?
Yeah, it's a brand new buy for me. I'd been wanting to complete that trifecta I just mentioned for some time.
Okay.
But Goldman was the strongest one among the 3, and the price really wouldn't come down from the 9s.
Well, it did.
And so finally, around $7.85, I got an opportunity and decided to start buying.
I like the move. Because I don't think things are falling apart, and if they don't, capital markets and investment banking, M&A, all the things that Goldman does literally better than anyone else should continue to shine. I'll show you the anti-Goldman. Give me a chart of Robinhood right now. This stock is literally sitting on a breakdown level. You got to give me longer than that, guys. This is in a 50% drawdown. You want to talk about an indicator of investor sentiment. And I know there's a lot of crypto in here. Look at this level of support that Robinhood has been sitting on top of basically since the beginning of February. You don't want to see what happens if this breaks down. You could be looking at a $50 stock relatively quickly. That's concerning because I think that stock, more than most others, speaks to the risk appetite of the regular investor. The other name that
hold on real quick. Let me just.
Okay.
I don't want you to get off that yet, because this plays perfectly off of what you're just talking about. According to JP Morgan, retail money invested is down about 15% week over week, and in total 43%. Retail money invested down 43% more or less since the start of the conflict.
It turns out people really love instant gratification when they put money to work, and when they don't get it, the trend weakens or goes in reverse. I think that's what we're seeing here. We've had a very long run of people getting that instant gratification. I put $10,000 into the market. It's worth $11,000 a week later. Look what a genius I am. When that goes into reverse and 10 becomes 8, obviously, you start to see that enthusiasm slow a little bit.
I don't want to get off the banks.
Just
I want to give Shannon a chance to comment on it, because you're the same day that you get a big win for the banks, the new regulatory recommendations, the requirements under so-called Basel III are a huge win for the industry. You're going to have much more lenient capital requirements. Presumably, you can lend more, you can give more money back to your shareholders. It's undoubtedly a huge win on something that the industry has been lobbying heavily for a long, long time. How do you see that?
Last year, this is all we talked about was Basel III endgame and the fact that we were moving away from that. And Scott, to your point, and to Josh's point, you get a reversal here in terms of the rate outlook, and you go from even, expectations of flat to a hike for the Fed, and you price back in one interest rate hike or one interest rate cut. You also start to see
Freudian slip. Freudian slip. You watched that news conference a little too closely yesterday.
The other thing that I really think that Malcolm just mentioned is that there's a significant amount of capital market activity that's going to come in the second half of this year. We're already seeing a pickup in M&A transaction deal flow. Those haven't closed yet, Scott, but that is not going to last forever. And so these catalysts for the financials, I don't think we can put them to the side for this year. And I think that this could be an excellent opportunity if you're underweight in this sector to start dollar cost averaging into positioning based on the fact that there are some of these things that I think will become tailwinds once again, coming from headwinds right now.
What do you think?
I think that it also makes sense that we have to consider how many refinancings are going to come into the market very soon if we do see a move in rates to the positive
better
side.
get a big move down in rates and real quick.
Well, I don't mean residential real estate. I mean more from the commercial perspective. I think the banks are taking back some of these loans we've been asking questions about from the private credit market over the last year. I think that's probably going to pick up because a lot of investors are moving away from that space, and so the capital available for it is going away too. So we're going to see more traditional lending pick up too, I think, in the larger business segment if we do see interest rates become more favorable.